Good morning, good afternoon, and good evening. Today we will talk about Chapter 10, Part 3. Are you ready? Here we go! Reaping reward by increasing risk. What are the lessons for investors from behavioral finance? Night owls like myself often watch the late-night TV shows. One of the funnier bits from David Letterman's show was the segment, Stupid Pet Tricks, where pet owners have their animals perform all manner of dumb antics. Unfortunately, investors often act very much like the owners and pets on the TV show, and it isn't funny. They are overconfident, get trampled by the herd, harbor illusions of control, and refuse to recognize their investment mistakes. The pets actually look smart in comparison. We have just seen how various aspects of human behavior influence investing. In investing, we are often our worst enemy. As Pogo put it, we have met the enemy and it is us. An understanding of how vulnerable we are to our own psychology can help us avoid the stupid investor delusions that can screw up our financial security. There is an old adage about the game of poker: if you sit down at the table and can't figure out who the sucker is, get up and leave because it's you. These insights about investor psychology can keep you from being the patsy. Charles Ellis, a longtime observer of stock markets and author of the brilliant investing book Winning the Loser's Game, observes that, in the game of amateur tennis, most points are won not by adroit plays on your part but rather by mistakes on the part of your opponent. So it is in investing. Ellis argues that most investors beat themselves by engaging in mistaken stock market strategies rather than accepting the passive buy-and-hold indexing approach recommended in this book. The way most investors behave, the stock market becomes a loser's game. How easy it was in early 2000, when a tech stock you bought moved persistently higher, to convince yourself that you were an investment genius. How easy it was then to convince yourself that chasing the last period's best-performing mutual fund was a sure strategy for success. And for the few who gave up their jobs during the bubble to engage in day trading, how exhilarating it was to buy a stock at 10 a.m. and find that it had risen 10% by noon. All of these strategies ended in disaster. Frequent traders invariably earn lower returns than steady buy-and-hold investors. The first step in dealing with the pernicious effects of our behavioral foibles is to recognize them. Bow to the wisdom of the market. Just as the tennis amateur who simply tries to return the ball with no fancy moves is the one who usually wins, so does the investor who simply buys and holds a diversified portfolio comprising all of the stocks that trade in the market. Don't be your own worst enemy. Avoid stupid investor tricks. Here are the most important insights from behavioral finance. 1. Avoid herd behavior. Behavioral financial economists understand the feedback mechanisms that lead investors to follow the crowd. When internet stocks were consistently rising, it was hard not to get swept up in the euphoria, especially when all your friends were boasting of their spectacular stock market profits. A large literature documents the pervasiveness of the influence of friends on one's investment decisions. Robert Shiller and John Pound surveyed 131 individual investors and asked what had drawn their attention to the stock they had most recently purchased. A typical response was that a personal contact, such as a friend or relative, had recommended the purchase. Hong, Kubik, and Stein provided more systematic evidence as to the importance of friends in influencing investors' decisions. They found that social households, those who interact with their neighbors or attend church, are substantially more likely to invest in the market than non-social households, controlling for wealth, race, education, and risk tolerance. Any investment that has become a topic of widespread conversation is likely to be especially hazardous to your wealth. It was true of gold in the early 1980s and Japanese real estate and stocks in the late 1980s. It was true of internet-related stocks in the late 1990s and early 2000 and condominiums in California, Nevada, and Florida in the first decade of the 2000s. Invariably, the hottest stocks or funds in one period are the worst performers in the next. And just as herding induces investors to take greater and greater risks during periods of euphoria, So the same behavior often leads many investors simultaneously to throw in the towel when pessimism is rampant. The media tend to encourage such self-destructive behavior by hyping the severity of market declines and blowing the events out of proportion to gain viewers and listeners. Even without excessive media attention, large market movements encourage buy and sell decisions that are based on emotion rather than on logic. Because of bad timing, the typical mutual fund investor earns a rate of return from the stock market far below the returns that would be earned by simply buying and holding a market index fund. This is because investors tend to put their money into mutual funds at or near market tops, when everyone is enthusiastic, and to pull their money out at market bottoms, when pessimism reigns. The exhibit on page 255 makes the point. In the chart, we see that net new cash flow into mutual funds peaked when the market reached a high in early 2000. At the market trough in the fall of 2002, investors pulled their money out. In late 2008 and early 2009, just at the bottom of the market during the financial crisis, more money went out of the market than ever before. You can see the effects of this timing penalty in the chart. There is also a selection penalty. At the peak of the market in early 2000, money flowed into growth-oriented mutual funds, typically those associated with high technology and the Internet, and flowed out of value funds, those funds holding old economy stocks that sold at low prices relative to their book values and earnings. Over the next 3 years, the value funds provided generous positive returns to their investors, and growth funds declined sharply. During the third quarter of 2002, after an 80% decline from the peak of the Nasdaq index, there were large redemptions out of growth funds. Chasing today's hot investment usually leads to tomorrow's investment freeze. 2. Avoid overtrading. Behavioral finance specialists have found that investors tend to be overconfident in their judgments and invariably do too much trading for their own financial well-being. Many investors move from stock to stock or from mutual fund to mutual fund as if they were selecting and discarding cards in a game of gin rummy. Investors accomplish nothing from this behavior except to incur transactions costs and to pay more in taxes. Short-term gains are taxed at regular income tax rates. The buy-and-hold investor defers any tax payments on the gains and may avoid taxes completely if stocks are held until distributed as the gains and may avoid taxes completely if stocks are held until distributed as part of one's estate. Remember the advice of the legendary investor Warren Buffett: lethargy bordering on sloth remains the best investment style. The correct holding period for the stock market is forever. The cost of overtrading is quite substantial. Using data on the trading behavior of approximately 66,000 households during the period 1991 to 96, Barber and Odeen found that the average household in the sample earned an annual return of 16.4%, while the market returned 17.9%. In contrast, the annual return to the portfolio of households that traded the most was only 11.4%. In other words, the portfolios of those households that traded the most substantially underperformed more passive benchmarks. In addition, men tended to be more overconfident and trade far more frequently than women. Odeen's advice to investors: if you are contemplating making a stock trade, and you are married, ask your wife whether you should do it. 3. If you do trade, sell losers, not winners. We have seen that people are far more distressed at taking losses than they are overjoyed at realizing gains. Thus, paradoxically, investors might take greater risks to avoid losses than they would to achieve equivalent gains. Moreover, investors are likely to avoid selling stocks or mutual funds that went down, in order to avoid the realization of a loss and the necessity of admitting that they made a mistake. On the other hand, investors are generally willing to discard their winners because that enables them to enjoy the success of being correct. Sometimes it is sensible to hold on to a stock that has declined during a market meltdown, especially if you have reason to believe the company is still successful. Moreover, you would suffer double the regret if you sold it and the stock subsequently went up. But it makes no sense to hold on to losing stocks such as Enron and WorldCom because of the mistaken belief that if you don't sell, you have not taken a loss. A paper loss is just as real as a realized loss. The decision not to sell is exactly the same as the decision to buy the stock at the current price. Moreover, if you own the stock in a taxable account, selling allows you to take a tax loss, and the government will help cushion the blow by lowering the amount of your taxes. Selling your winners will add to your tax burden. 4. Other stupid investor tricks. Be wary of new issues. Do you think you can make lots of money by getting in on the ground floor of the initial public offering, IPO, of a company just coming to market? Particularly during the great internet bubble that collapsed in 2000, it seemed that IPOs were the sure path to riches. Some successful IPOs began trading at 2, 3, and in one case, even 7 times the price at which they were first offered to the public. No wonder some investors came to believe that getting in on an IPO was the easiest way to coin money in the stock market. My advice is that you should not buy IPOs at their initial offering price and that you should never buy an IPO just after it begins trading at prices that are generally higher than the IPO price. Historically, IPOs have been a bad deal. In measuring all IPOs 5 years after their initial issuance, researchers have found that IPOs underperform the total stock market by about 4 percentage points per year. The poor performance starts about 6 months after the issue is sold. 6 months is generally set as the lock-up period, where insiders are prohibited from selling stock to the public. Once that constraint is lifted, the price of the stock often tanks. The investment results are even poorer for individual investors. You will never be allowed to buy the really good IPOs at the initial offering price. The hot IPOs are snapped up by the big institutional investors or the very best wealthy clients of the underwriting firm. If your broker calls to say that IPO shares will be available for you, you can bet that the new issue is a dog. Only if the brokerage firm is unable to sell the shares to the big institutions and the best individual clients will you be offered a chance to buy at the initial offering price. Hence, it will systematically turn out that you will be buying only the poorest of the new issues. There is no strategy one am aware of likely to lose you more money, except perhaps the horse races or the gaming tables of Las Vegas. Stay cool to hot tips. We've all heard the stories. Your Uncle Gene knows about a diamond mine in Zaire that's a guaranteed winner. Please remember that a mine is usually a hole in the ground with a liar standing in front of it. Your cousin's sister-in-law Gertrude was told confidentially about an undiscovered little biotech company. It's a screaming bargain. It's selling at only $1 a share, and they're ready to announce a cure for cancer. Think, for $2,000 you can buy 2,000 shares. Tips come at you from all fronts: friends, relatives, the telephone, even the internet. Don't go there. Steer clear of any hot tips. They are overwhelmingly likely to be the poorest investments of your life. And remember, never buy anything from someone who is out of breath. Distrust foolproof schemes. You will be told by amateurs and professionals alike that schemes exist to pick the best fund managers and to keep you out of the market when prices are falling. The sad fact is that it can't be done. Sure, there are portfolio strategies that in hindsight produced above-average returns, but they all self-destruct over time. There are even market timing strategies that have been successful for years and even decades. In the long run, though, I agree with Bernard Baruch, a legendary investor of the early 20th century, who said, "Market timing can only be accomplished by liars." And Jack Bogle, a legend of the late 20th century, has remarked, "I do not know of anybody who has done it, market timing, successfully and consistently." Investors should also never forget the age-old maxim: if something is too good to be true, it is too good to be true. Heeding this maxim could have saved investors from falling prey to the largest Ponzi scheme ever, the Bernard L. Madoff fraud uncovered in 2008, in which $50 billion was said to have been lost. The real con in the Madoff affair is that people fell for the myth that Madoff could consistently earn between 10 and 12% a year for investors in his fund. The genius of the fraud was that Madoff offered what seemed to be a modest and safe return. Had he offered a 50% return, people might well have been skeptical of such pie-in-the-sky promises. But consistent returns of 10 to 12% per year seemed well within the realm of possibility. In fact, however, earning such returns year after year in the stock market, or in any other market, is not remotely possible, and such claims should have been a dead giveaway. The U.S. stock market may have averaged over 9% a year over long periods of time, but only with tremendous volatility, including years when investors have lost as much as 40% of their capital. The only way Madoff could report such a performance was by cooking the books. And don't count on the regulators to protect you from such fraudulent schemes. The SEC was warned that Madoff's results were impossible, but the agency failed to act. Your only protection is to realize that anything that seems too good to be true undoubtedly is untrue. 5. Does behavioral finance teach ways to beat the market? Some behavioralists believe that the systematic errors of investors can provide opportunities for unemotional, rational investors to beat the market. They believe that irrational trading creates predictable stock market patterns that can be exploited by wise investors. These ideas are far more controversial than the lessons provided above, and we will examine some of them in the next chapter. Hi, ladies and gentlemen, we finally finished chapter 10. What do you feel? Do you feel more confident now? Are you ready for the new journey? We will see you in chapter 11. Cheers!